In the next 24 months, the very definition of owning an asset is set to be rewritten. The blueprint is already being deployed by the world's largest financial institutions, including BlackRock and JPMorgan. This isn't about speculative tokens. It's about a fundamental rewiring of the financial system, centered on two colossal trends that most investors still see as separate. But their collision is the real story. Behind the noise of the market, a quiet revolution is happening. The entire crypto market is moving from a phase of hype to one of real-world utility. This is a shift from speculation to infrastructure. And the part almost nobody is connecting is how these two trends, real-world asset tokenization and the rise of stablecoins as a global payment system, are about to merge into a single, unified engine for finance. By the end of this briefing, you will understand how this convergence works and what it means for the future of wealth. Let's be direct. The traditional financial system is built on decades-old technology. It's slow, expensive, and filled with intermediaries who take a cut at every turn. Why does it take 2 days for a stock trade to settle? Why does sending money across borders feel stuck in the 1980s? The system runs on leaky pipes. We've tolerated it because there was no alternative, but that's no longer true. We now have the technology to build something new, not just patch the old system. This is what we call the Great Financial Migration. We're moving from a world where value is locked in slow physical assets to a world where value flows like data, instantly and globally. Is this just a niche movement? The giants are leading the charge. BlackRock, JPMorgan, and Franklin Templeton aren't just watching, they're actively building the bridges. They see where this is going. The question has shifted from if to how fast. Institutional investors are gearing up to increase their focus on digital assets, and the consensus is clear. This brings us to the main event. What happens when these two foundational trends, tokenized assets and stablecoin rails, finally collide? That's where the financial system as we know it begins to change. So what are these two trends? The first is the tokenization of real-world assets, RWAs. The second is the evolution of stablecoins into the world's new financial railway. Independently, each is powerful enough to reshape entire industries, but their true world-altering potential is unlocked only when they merge. This is the key insight. 2026 is the year these two forces stop being separate concepts and become one unified system. This is the year DeFi could stop being the alternative and start becoming the system. A new foundation for finance is being built, one where tokenized real estate, bonds, and private credit are bought and sold using stable, programmable money, all on-chain 24/7. The groundwork is already laid. The institutional players are already here. But to see the full picture, we have to break down each titan. Stick around because the power of the first is useless without the second. First, real-world asset tokenization. What does it actually mean? It's turning a real-world asset, like a skyscraper, a portfolio of loans, or US Treasury bonds, into a digital token on a blockchain. Here's a vivid example. Instead of selling a $100 million office building in one piece through a slow, painful process, you can tokenize it into 1 million digital bricks for $100 each. Suddenly, you can trade ownership in that building on a global market 24/7, just like a stock. This brings a key number into focus. Forecasts predict the market for tokenized assets could surge from billions today into the trillions by 2030. This isn't just theory. Look at BlackRock's BUIDL fund, which tokenizes US Treasury bonds. It launched in March 2024 and grew to over $2.8 billion in just over a year, becoming the largest fund of its kind and proving institutional demand is real. So, what's the implication? The most valuable, illiquid assets in the world are on a path to becoming as easy to trade as stocks. We're also seeing this with JPMorgan, which is now tokenizing interests in private equity funds on its Onyx platform, aiming for a full rollout by 2026. This unlocks wealth for more people and makes markets radically more efficient. But these newly liquid assets need a way to be paid for. That brings us to the second titan, stablecoins. The old view was that they were just casino chips for the crypto world. That view is now obsolete. In 2025 and 2026, stablecoins are becoming fundamental financial infrastructure. Think less casino chip and more high-speed rail network for global value. Here's a vivid example. A multinational corporation needs to move $50 million from its US division to a supplier in Japan. The old way involves days of wire transfers and foreign exchange desks. The new way? A treasurer executes a single transaction with a regulated stablecoin, and the funds settle in minutes. The numbers here are staggering. In 2023, stablecoins settled over $10 trillion in transaction volume. While not a perfect apples-to-apples comparison, this shows they can operate at a scale rivaling major payment networks. They run 24/7 with no banking hours. The core implication is that stablecoins are no longer just for traders. They're becoming the default payment rails for serious global business. This is driven by regulatory clarity, like Europe's MiCA regulation, which provides rules for stablecoin issuers. Major players like Visa and PayPal are already integrating them for settlement. They are the programmable money that will make buying and selling all those tokenized assets completely seamless. So we have the assets and we have the payment rails, but when they combine, something entirely new emerges, and it changes everything, especially when it comes to borrowing. This is the core of the thesis. The megatrend of 2026 isn't tokenization or stablecoins, it's their convergence. This is where we get a glimpse of a new financial era. Here's a simple mental model. Tokenized assets are the new powerful freight trains. Stablecoins are the high-speed rails. Separately, they are impressive. Together, they create a global automated commerce engine that never stops. But here's where the system really flips. Wait until you see how this changes borrowing. Picture this. You own a tokenized fraction of an office building in Tokyo. You need a loan. In the old world, using a foreign property as collateral would be a bureaucratic nightmare. In the world of 2026, it could be effortless. Your tokenized real estate, sitting in your digital wallet, is instantly recognized as collateral by a decentralized lending protocol. You lock your token in a smart contract and immediately receive a loan in a stablecoin. The whole process could take minutes, with no loan officers and no weeks of waiting. This creates a clear divide. The winners will be the platforms and investors who understand this integrated system. The losers? The legacy middlemen whose functions are being automated by smart contracts. The stakes aren't just faster transactions, it's a fundamental shift in who captures value in finance. But this high-stakes, automated world has a fatal flaw: privacy. For institutions to move trillions onto blockchains, they require privacy. They can't broadcast their entire financial strategy for competitors to see. This has been a major roadblock. The solution is a cryptographic breakthrough called zero-knowledge proofs, or ZKPs. A ZKP lets you prove something is true without revealing the secret information behind it. For finance, this is revolutionary. A bank can prove it has sufficient reserves without showing its exact positions. This technology provides the transparency of a blockchain with the confidentiality that institutional finance demands. Privacy-focused protocols are critical to unlocking institutional DeFi. The second enabler is artificial intelligence. AI is the brain that will run on these new financial rails. We're already seeing AI-driven DeFi strategies that optimize investments and manage risk. As Ethereum's co-founder, Vitalik Buterin, has noted, AI can be used to supercharge human judgment in these systems, not just replace it. In 2026, we'll see the rise of AI agents, autonomous programs that execute complex financial strategies. So the technology is here, but how do you, as an investor, separate the signal from the noise? That's the most important question. The investment game is changing. The market is finally starting to reward infrastructure over hype. The opportunity is to see this shift before the mainstream. Here's a simple 3-step framework for navigating this new landscape. Step 1. What to watch, the indicators. Focus on the plumbing. Watch the protocols and platforms attracting real-world asset projects, especially in areas like private credit and US Treasuries. These are the foundational layers. Step 2. What matters? The metrics. Shift away from token price hype. The new key metric is utility-driven revenue. Is the protocol earning real fees from transactions, lending, and settlement, not just speculative trading? Look for projects solving actual business problems. Step 3. What signals adoption? The green lights. The ultimate signal is institutional product launches. When major banks like JPMorgan move beyond pilots and launch commercial products on these platforms, like the Connexus Fund Flow platform, that's the green light. It signals the infrastructure is trusted and ready for serious capital. To recap, we are on the cusp of a financial revolution driven by the convergence of two megatrends: the tokenization of trillions in real-world assets and the rise of stablecoins as global financial rails. This merger is unlocking liquidity and building a seamless 24/7 global market, powered by critical enablers like ZKPs for privacy and AI for intelligence. We are moving from a world of pure speculation to a world of utility, and the opportunities for those who understand this shift are immense. The key takeaway is this: the very definition of wealth is expanding. Future assets will likely be a dynamic, on-chain portfolio of tokenized instruments you can use, borrow against, and deploy in ways we are just beginning to imagine. If you found this briefing valuable, make sure to subscribe and hit the notification bell for more deep dives into the shifts that truly matter. Now, I want to leave you with a question. As we see everything from real estate to private loans get tokenized, what real-world asset do you think will be the first to be tokenized on a truly massive global scale? Drop your answer in the comments below. Thanks for watching, and we'll see you in the next one.